Hey y'all, Michael Smith here with the Bluefield Group, and today I'm joined by Adam Groblewski with Guild Mortgage, and we're going to be talking about interest rates. Alright, so Adam, when you are consulting with a new client and you're talking about interest rates and mortgage payments and closing costs and all that good stuff, I understand there's not just one rate for the day, right? There's actually some options.
Absolutely, yeah. Something a lot of people don't know is lenders have a variety of interest rates that they can offer to a client at any time. So, you might think, okay, well, hey, let's just get the lowest rate possible. Lower is always better, right? Well, not always. There's fees, there's costs to getting that lower rate. And then conversely, you can get a lender credit back to do a higher rate. So to kind of explain that more, I'll just explain the par rate. When we talk about the par rate, that's what most lenders should be quoting as, kind of the daily rate or what the rate is that day. There's no additional cost to get that, and there's no lender credit that you would get back for that par rate. So I'd love to give some examples, but I should say that these are hypothetical examples just for the purpose of explaining and illustrating buying down an interest rate and paying points. These are not the actual rates that we're offering today, just hypothetical examples.
Yeah, just some quick numbers so we can understand the concept from a high level.
Exactly, simplified to make it easy. So let's just say the par rate today is 4.75. So there's no additional cost to getting that 4.75 rate.
So you're still going to have closing costs, but not discount points, right? So maybe we can make that distinction.
Exactly.
Right.
Yeah.
So even at the par rate, most lenders are still going to charge an origination fee, right? Which could be, itemized a few different ways on the loan estimate, right?
Exactly. Yeah.
Okay.
Processing, underwriting, maybe a credit report, different things like that.
Okay.
Lenders' fees, attorneys' fees, taxes, insurance, a good number of things that are just all the normal fees that you would pay. But points are an additional fee that you would pay. So if the par rate was 4.75, let's say you could buy down the rate to a 4.5 rate by paying 1 point. So
what is a point, Adam?
What is a point? So a point is a percentage of the loan amount.
Okay.
That would be additional fees that you can pay in order to buy down that interest rate.
Okay, so if you've got a $200,000 loan amount, paying 1 point is paying $2,000.
Exactly.
Right. Okay.
Yeah, great. And $2,000, that was actually a great number. That was the kind of the numbers I looked up. That would, in that example, that would save about $30 per month if you have a $200,000 mortgage going from a 4.75 to a 4.5. So $2,000 to save $30 per month.
So under what circumstance would that make sense?
So great question. One thing that's super important is talking to your lender, explaining why you're buying a house, what your time frame is to live in the house, what your goals are for the monthly payment and the amount that you want to bring to closing. But the quickest, the easiest way to determine if that makes sense is what's called a break-even analysis. And a break-even analysis, it's just a math equation to figure out, okay, I paid $2,000 up front. How long will it take me to recoup that $2,000 from my $30 per month savings? So for that example, that would take about 66 months. So $2,000 divided by the $30 per month would be 66 months. It would take 66 months to recoup the $2,000. That's about 5.5 years.
Okay.
So if this is going to be your forever home, that might make sense. After that 5.5 years, you're saving $30 per month. So if this is a home that maybe it's a starter home or you're just not really sure if you're going to be there for more than 5 years, probably doesn't make sense to outlay that money up front because you may not recoup it before you sell or move on to the next thing with the house.
Okay. So let's say instead of wanting to pay extra up front in order to get a lower interest rate, let's say we want to do the opposite. Maybe we are okay taking a higher interest rate if it helps us save some money today. So what would that look like?
Yeah, absolutely. So let's go back to the example. We had the par rate at 4.75. So normal closing costs. If you go up to, let's say you go up to a 5% rate and you could get back a lender credit of 1%.
So $2,000 saved today.
$2,000 would lower those closing costs by $2,000
Okay.
in that example. So again, with your lender, you can sit down and do a break-even analysis to see if that makes sense to have less closing costs. People with a short-term time frame, or maybe just don't have a whole lot of money in the bank. You know, in today's market, it's not as easy to get the sellers to pay closing costs.
That's the truth.
So if someone has limited money, they can discuss with their lender buying down the interest rate to reduce what they have to bring to the table.
Okay. So by jumping up from the par rate of 4.75 up to 5%, I'm assuming that would probably cost an extra 30-ish a month. Something around
yeah,
there.
$30,
Right.
$31 a
So
month.
you save $2,000 up front, your payment's going to go up by about $30 a month, right? And so using that
Yep.
same analysis, it'll be about 5.5 years, right?
Exactly.
Before you end up
Yep.
paying an extra $2,000 in interest
Exactly.
over those months,
Yeah.
right? So if you know that you're going to either pay off the mortgage or, you know, sell within the next 5 years, it probably does make sense to do that.
Yep,
Right.
exactly.
And
Exactly.
so how many choices on any given day do we actually have? Is it just par, a little bit below and a little bit above, or how does that work?
Yeah, so that was a simple example. Different programs offer different rate sheets that can have, some may have 5 different rates. Some may have 15 different rates, spanning all the way from something that would absolutely make no sense at all, paying like 5 points
Wow.
for some super low rate,
Wow.
up to something getting a huge credit back and having a rate that's just very high.
Really, really high.
Yeah, but you bring up a good point. It may make sense to pay a small amount of points, maybe not 1%, 1 point, but maybe an eighth or a quarter. That may cost $500, but you may be able to save an amount per month that's worthwhile of making that investment, depending on your time frame.
And also depending on your overall credit file, right? So maybe if you need to save just a little bit per month in order to get your debt to income ratio where it needs to be to qualify, that could be a circumstance,
Yeah,
right?
Exactly. Yeah, exactly. Some people, they have a certain number in their head they want for that monthly payment. Got to be under $1,000 or under $1,500.
Right.
Hey, that might be a way to get it where they want it.
And so let's say, just hypothetical here, let's say that your closing costs are $5,000, right? And you've got a $200,000 loan amount. So could you theoretically take 2.5 points to cover all of those closing costs and not pay anything in order to close?
Yeah, hypothetically,
Okay.
you could take full points, cover all of the closing costs. And yeah, again, that would just be where your lender sits down with you, kind of shows you what that brings that monthly payment up to.
Right.
I think what you'll find is getting up to like 2 points, really high amounts, doesn't always make sense, if you have the money in the bank to be able to use that.
And what about your down payment? Is it possible to use points to cover not just your closing costs, but also your down payment?
Okay, you can't use a lender credit to cover down payment,
I had to ask.
unfortunately.
Yeah, I had to ask.
And many people would have if you didn't. Hey, can we use that? If you have closing costs, the lender credit can cover those, but it can't spill over into down payment.
Sure.
There are some no down payment programs that still exist out there. In fact, more of them are coming out. But if you have let's say 3% down, you have to bring that 3% down, whether it's from you or from a gift. The lender credit can't spill over and cover all or part of that.
Okay, so that minimum down payment requirement, you still have to cover it, but you can wipe out all of your closing costs through a lender credit if you're willing to take a higher interest rate.
Yep.
Okay. All right, y'all. Thanks so much for watching. I hope this was valuable for you. If there are any other real estate related topics you'd like us to cover, please leave that in the comments below. Again, you can always hop over to bluefieldgroup.com/videos to check out more of our content. Adam, thank you so much.
Yeah. Thank you, Michael.
And we will see y'all on the next one.